Hi there, good morning. My name is Victor Louis, and I'm the head of investments at Sankore Global Investments. This is your weekly financial market roundup. We start over in the US, where stocks slipped on Friday after a stronger than expected jobs report. The S&P lost 0.11%. The Dow was down 89 points, while the Nasdaq shed 0.23%. Nevertheless, all three major indices notched a winning week. For the week, the Dow gained 0.29%. The S&P added 1.32%, while the Nasdaq rose 2.38%. The job numbers came in on Friday, and we saw non-farm payrolls rising by 272,000 jobs in May. This was significantly higher than the 175K that we had seen the previous month, and also higher than the 190K that the market had expected. We also saw hourly wages rise 0.4% month on month and 4.1% year on year. This job data clearly reflects a very, very resilient labor market that continues to dampen hopes of a Fed rate cut later this year. In fact, on the job numbers, we saw the 10-year US Treasuries rise more than 15 basis points on Friday as well. So really, it was largely about that job numbers last week. Going into the new week, really, all attention will be focused on the US Fed. It's meeting between the 11th and the 12th. With its decision on the 12th, but the market really expects that it will hold rates steady. However, we've seen a slew of recent rate cuts from a number of global central banks. More recently, we saw the Bank of Canada and also the ECB just last week, and this could put some sort of nudge, if you will, on the Fed to kind of try to tow the same path. But nevertheless, the data at home doesn't allow it to really be on that path for now. Also, this week, we'll be expecting CPI data, interestingly, on Wednesday as well, when we're expecting the Fed decision, while consumer sentiment data from the University of Michigan will be out on Friday. So really, for the week, it's really all about the Fed and its interest rate path. Obviously, market will be listening to see whether we would, get a more significant dovish pivot, if you will, from the Fed, particularly looking at the data point that we had seen leading up to the job number that we saw on Friday. The oil market posted its third straight weekly loss last week on concerns that demand may be softening, particularly again because as OPEC Plus plans to increase production, as most of its voluntary cuts would expire in Q3. So there's a 2.2 million barrel per day voluntary cut that is set to expire in October. And what that simply means is that those barrels will basically come back onto the market and essentially increase supply. However, we've seen a recovery over the weekend, really, particularly as we get into the summer driving season in the US, where demand typically rises significantly. So that could serve to counter the supply concerns that the market is looking at for crude oil. So we are likely to see crude oil prices essentially stay stable through the summer driving season, particularly as supply concerns seem to be counterbalanced by growing demand on the back of the summer driving season in the US. Over in Europe last week, like I highlighted earlier, the ECB cut rates for the first time since 2019 in a widely expected move, even in the face of nagging inflation concerns. We saw inflation rise in May to 2.6% from 2.4% the previous month. However, the European Commission still expects that inflation will moderate to 2%, next year. So the benchmark rate now has dropped from 4% to 3.75%. Also, it was a big week politically in Europe. We saw elections into the European Parliament. Although the center-right EPP still won majority of the seats, we however saw far-right populist parties winning record support, particularly in France. And this has led to Emmanuel Macron calling for snap elections in France. And this obviously has implications, not just in France, really, but for the euro in all. So again, we'll continue to monitor developments politically in the Eurozone. Over in China, Chinese exports growth came in stronger than expected for the month of May. It rose 7.6%. This was higher than the 6% that was expected. However, imports rose much slower, 1.8%, which was significantly lower than the 4.2% that had been expected. Also, from this passing through the data, we basically noticed that trade between China and the US and the EU fell during the period. However, trade with the Association of Southeast Asian Nations rose. Chinese exports to that region, rose by 4.1% year on year. And this again just continues to reflect this whole theme around deglobalization, where countries are really trading more now with blocks close to them or regions around them, as opposed to the very strong global trade that we had seen before the pandemic hit. Global restrictions really are on the rise, but trade restrictions now, about 3,000 trade restrictions were imposed last year alone. And this is significantly higher than the just about 1,000 that we saw in 2019. So clearly this whole, trade war, subtle trade war, this whole deglobalization thing seems to, be continuing to be sort of entrenched, albeit shortly. Also, if you look at the Chinese data, crude oil imports were essentially flat in the first 5 months of the year compared to the same period last year. Again, this looks like a sign of a weakening, domestic demand. Locally here in Nigeria, liquidity still remains really, really tight. The T-bills market traded on a mixed note last week. Sentiment was largely bearish at the beginning of the week as participants basically sought to raise liquidity. That trend was, however, somewhat reversed post the auction on Wednesday. Some field bids, particularly at the long end of the curve, filtered into the secondary market. The auction saw a 2 basis points reduction in the stop rates on the 1-year paper. Again, for us, this is a very strong signaling that the fiscal authorities are not willing to go beyond these levels in terms of the rates that they are looking to offer. The bond market was pretty much the same thing, was relatively calm. Limited trading observed, with some trades actually consummated. However, yields at the treasury bills market and at the bonds market also was largely flat, on average. So for this week, really, it's all about the Fed. Market is already expecting that it would hold rates, but more importantly, the things that it says or the kind of guidance that it gives, going forward on its rate path and how it perceives of the inflation trajectory and also the nagging strength, if you will, of the labor markets. I think that's pretty much it in terms of our updates. Thank you very much for your time, and we hope that you do have a very, very productive week. Thank you very much.